Webcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thanks for joining us today on another one of our monthly educational webinars. I'm Brittany Melville, the Director of Marketing and Sales with Next Generation. And today we have some special guests joining us to talk about a very interesting topic, music royalties, and investing in music royalties with a self-directed IRA is what we're going to cover for you today. So with us, we have Tim and Connor Gallagher. They are with Music Royalties, Inc. So they will take us through a little bit of background on the industry itself, and then talk to us about how these could be potentially lucrative investments. And then I will tie that into how it works with an IRA, if that's something that you'd like to do. So just a couple housekeeping notes real quick. We are slated for about an hour of time here to do this educational session. We'll leave time at the end for questions. Also, the webinar is being recorded. So if you have to drop off, or if you registered and you weren't able to join us live, we will be sending you a copy of this recording that you can reference for future, and our contact information will be available with that. And if you do have any questions throughout this session, feel free to enter them into the chat or questions box on your right side panel there, and we will field those as soon as we are done here. So with that, I am going to hand it over to Tim and Connor, and they'll take us into the world of music royalties.
Okay, thanks, Brittany, and welcome everyone. Let's just start by saying we discovered this category about 3 years ago, having come from the gold royalty world, and we came really into this awareness when we saw in the newspaper $1 billion was paid out via broadcast music in the US, which is a song collection society, and to 700,000 artists. So over time, and it's hard to explain all the details, but this is the convergence of a number of themes: the explosion of streaming in all its forms, and the internationalization of the business, and a category from an investor perspective that virtually no one, unless you're in the entertainment business, even knows about. So we've come to think that it's actually the best investment, and certainly the one asset class that nobody owns. So I'll just move in 3 sections. We'll try to cover a little bit of background on the music industry at a high level, and why we think there's an analogy to the real estate world, cash flows backed by an asset. And probably you've noticed this industry of late through the selling of big artists positions. You know, I think the notorious Taylor Swift deal was one recently put out with the Scooter Braun, the historic Michael Jackson purchase of the Lennon-McCartney interest back in the 80s. If you're in the finance world, the only other deal in the last 30 years that came up, in the financial news, was the David Bowie bonds back in 1997. But otherwise, it turns out that there's billions of dollars when you add up all these streaming interests and other cash flows that have replaced the physical world, the old record stores. And we have a booming global streaming business that's interesting, and it's a highly diversified international income. So you'll see more and more of this in the press. So when it comes down to this investment, it's really on the back of the technology that's been created by the FANG stocks. So it's not the music industry per se, but it's what they've done with the technology over the years, going back as far as, I guess, the iPod getting created in 2001, the iPhone in 2007. Bit by bit, we got broadband access, and the next thing you know, we have 3 billion smartphones out there playing music, and you add on smart speakers, you add on the music that's behind the new Netflix-like players. You've got brand new, I call them record stores. Even TikTok is a new, in quotes, record store generating new revenues. So the point is, all these pennies are going to various owners of songs, and most people don't realize that they're not 100% owned by the artist. Typically, and I simplifying it, it would be owned by the record company or label for say half of it, and the other half is split amongst the artists, the producers, the managers, the songwriters, and so on. And it's really those small interests that we're trying to aggregate into a diversified portfolio that would be of interest to any individual at even a small level, family offices, institutions, and pension funds, because of course, at the core of every investment is the desire to have a long-term diversified cash flow, let alone one that's growing. So when you think about what this business is arrived at, it's essentially a utility business, because other than eating and drinking, the next most important item is probably our cell phone, which is, if you're signed up for the music, is $3 a month. You could get the free version, but it's something that you're unlikely to give up. And over time, you know, from when we started in early 2018, the entire music business only had subscriptions that were less than Netflix. Now we have a few hundred million, but it's really, frankly, only in the first or second inning, if you look at the global growth story. So in terms of this music, the most interesting thing that stood out for me compared to coming from the mining industry was really the fact that it's copyright protected in the case of songwriters. So it's the life of the author plus 70 years. So we call it 100-year cash flows. So you've got a cash flow that's growing in the form of streams that have long-term protection on a global basis. Whoops. Now here's a quick reminder of the evolution of the music business, you know, through the eyes of technology. You know, it started off as a technology even when it was in the form of a record, going back to the days of Edison, switched over to cassette, peaked, practically speaking, with the CDs in the year 2000. Napster shows up and frankly cuts the business in half. You can see the slow growth from the start of the MP3 turning into the iPod, ringtones. It's sort of still clunky, if you will, downloading to create playlists and so on. And the streaming business starts. And you'll see we have only one public reference with Netflix. But even when we got started, so this takes us to 2017, it's really just getting going. And of course, most of the artists are still complaining about these part pennies, but I think from an outsider's perspective, we've gone from 30 million hippies, say 50 years ago, to 3 billion smartphones as customers. So it's a more in the realm of an infinite expanding universe rather than the linear progression of some stores in the past. But that's of course true for all businesses. The only ones that are really growing are the online businesses. So in a different format showing the growth profile, you know, we got started here at the beginning of 2018, and you can see the forecast from Goldman Sachs is taking this out over the next decade and beyond to a tremendous, you know, growth story. And the key thing now is relative to the past, when everything was sort of a black box and you didn't know in the physical world, you know, where these revenues were coming from. Now an outsider can practically speaking look at a song and see how it's doing just by looking at YouTube, Spotify, and iTunes. You get a good sense of whether you're dealing with, you know, a 1 million, 10 million view song, or whether you've got a, you know, a billion view song, you know, and you can also track the growth rates accordingly. So as I said at the beginning, the biggest surprise was when you add up these performing rights organizations, which are the big ones in the US being Broadcast Music Inc., BMI, and you can look at that at BMI.com, or ASCAP, American Society of Composers and Producers. There's other ones like CSAC and Sound Exchange and so on, but they're paying out billions of dollars to hundreds of thousands of artists, and really there's no market for these individual rights holders, other than perhaps at the very high end, those artists we mentioned at the beginning, you know, will cut deals with record companies or large private equity funds. So it's the opportunity, or the unlimited opportunity, to consolidate these various interests. And of course, if we bring it into the public market, then we'll allow all the fans to participate in a diversified portfolio, which is exciting. So I don't want to get into the technical details on this, but if you think about the way the revenues are being generated in general, we've got all these new electronic distribution systems. You've still got the radio, you've still got the Sirius satellite and Pandora. You're still generating advertising revenue or sync licenses from movies and advertising, and all those revenues are going back to, in this example, the songwriters, and the creators, the rights holders. Okay, so when you're talking about the vision that I have as an investor compared to the public market, government bonds are all plus or minus 1% around the world. So it's a pretty low return. Maybe banks are even zero. So we're seeing this view of 5% to 20% yields in this private market. So we're just trying to aggregate those bonds, if you want to call it, those cash flows held by those individual rights holders into a portfolio where we can just essentially redistribute those that cash flow in the form of monthly dividend payments. So as we've highlighted, we've got long-term cash flows protected by copyright. We're relying on the international system of collection, which ultimately means having accounts, on your behalf through the music companies or through the performing rights organizations in various countries and so on. So in terms of pure valuation, I'm going to say the range that we've seen is between round figures 5 times cash flow to 20 times cash flow. And when you're looking at the distribution of the ownership, as we already mentioned, and perhaps if you have Spotify, I would point out that if you look at the 3 dots on the right of every song, you can scroll down and you can see the song credits, which is a pretty good reference for how many owners there are involved in that particular song. So, when you look at the old singer-songwriter era, you'll see, Jagger, Richards, or Lennon, McCartney, and you think, okay, we got to pay the band, we got the producers, the managers. But in the most recent song we got an interest in with Drake, it was a surprise to see that he had 14 co-writers on that song, plus 3 producers. So it shows you how fragmented this market is. So when it comes down to the portfolio idea, it's not about the sort of the average song that would decay from its initial popularity off of the radio. It's really trying to isolate the best material that was ever created, and we've defined that as the best songs of the last 6 decades. So we think that if something became a member of the top 100 on Billboard, as an example, that it became a brand that everybody's aware of, and that obviously includes a lot of one-hit wonders. And one of the ones that we have an interest in is Dancing in the Moonlight. And of course, none of us could have played that song, but if you look at its trajectory over the last couple of years, it's being rediscovered all around the world, and it's now crossed 100 million plays just on Spotify. It's been redone and modernized by a Swedish group. It's even been done by a K-pop group. So, well, I guess the only thing left is for it to get discovered on a TikTok. So that's the kind of new ecosystem that we're talking about. So I understand it takes a bit of time to assess all these little converging themes. The growth of streaming, the transition from the past when you typically bought an album to now it's basically you've got a computer using AI saying, because you listen to this, what about that? So it's this whole new thesis of online and automated business. Now, the analogy to real estate is you've got this asset that's been created that's, in quotes, a hard asset, and you, instead of having a tenant, we'll move to the next slide here, you've trying to make the point that there's lots of real estate, but if you've got a trophy property, in this case, a hit song, something that's got cumulatively maybe 1 billion plays, then you've got the best long-term asset you could possibly own. And if the tenant is really, in real estate terms, diversified by millions of people versus a single tenant, then even now, especially in this pandemic world with, you know, empty towers and people not being able to pay rent, you don't have any specific risk of a location, a building that's an office tower or a big box store or any of that kind of thing. So if we can focus in on the top 10,000 songs that everybody knows, you know, the soundtrack of our lives, if you will, then we think we've got location, 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 an iconic portfolio, and we can grow from there. Whoops. Oh yeah, sorry. In terms of the point about the passive nature of what we're trying to do, in the capital markets, we've evolved from individual stock picking, if you will, to this idea that you want a passive interest on a concept, like, and otherwise known as an exchange traded fund, an ETF. So instead of trying to pick which tech stock you might want to own, you just pick the index. And in this case, we're trying to create the equivalent of a music REIT or a music ETF. So the point is, relative to real estate, you know, you obviously don't have all the maintenance and the depreciation, you know, the tenants that come and go or any of those kinds of things. And in that way, we think it's a better investment. Plus, you have the opportunity of getting it modernized or a new copyright created and marketing to create new revenue streams. So, like the FANG stocks, you know, it just completely changes the mindset of an individual store or business. Because, you know, using Facebook as an example, I think they generate about 70 or 80 billion in revenue coming from 2.5 billion users. So it's small dollars per customer. That diversification translates into, you know, decreased risk. And so, and of course, it's growing, and you got all these viral abilities to market your story and so on. So all of these things you can take your time looking at. As far as another example of the iconic songs that we're trying to target, think of it every time you go to a stadium or a hockey arena or a big game, there'll always be these certain playlists that are covered that get people excited. You know, when you've got 25, 50, 100,000 people in a stadium all singing the same song, you know, you can call them campfire songs, but these are the kinds of things that are evergreen cash flows that are clearly interesting as investors. Now, underpinning all assets these days is the discount rate or the interest rate that you value that cash flow on. So, you know, probably best explained by the phenomenal pricing of the FANG stocks that are trading at, you know, some of them don't even have the bottom line, you know, to put a multiple on it. But the point is, all assets, including real estate and public companies, are valued based on the discount rate, and the fact that the interest rate is down to 1-2% means that these cash flows are worth that much more. So the risk, of course, if rates go back up, then, you know, that would compress the upside. But since we seem to be in this lower for longer interest rate environment, then it essentially means that this is a great opportunity to arbitrage the private market into a public portfolio. You know, this is not about being in the music business. It's basically participating in hit songs. So, you know, over the generations, you know, songs will be replaced, but they can also be redone by, you know, modern artists. And we've seen a lot of, you know, modern artists go back and take old songs and redo them and put their spin on it and create a new copyright. So when you talk about people who are doing this kind of business, clearly the big four music companies are in the business of managing catalogs and buying catalogs, you know, Universal buying Bob Dylan, but so Universal, Warner, BMG, the private German company, and Sony ATV. Now we've got also some private equity funds, one of which actually went public in the form of a fund on the London Stock Exchange. Hypnosis did that 2 years ago, and they've more or less raised $1 billion. But again, they're in fund structure. They're not in the structure where we try to grow it as an equity from 20 million market cap, where we are now, to $1 billion market cap. The Royalty Exchange is clearly another catalyst. It's a private company in Denver. They were trying to go public a couple of years ago off the Eminem sound recordings, and they didn't go forward with that proposition. And essentially that's what we do here in Canada. So the logic for us was, you know, looking at smaller deals to consolidate, take it public, move to a listing in the US and go from there. But the Royalty Exchange has had about 1,000 auctions. They definitely offered a bunch of interesting deals that allowed us to get access to some big name artists and some unique, older properties like that Dire Straits example I gave you from the retiring manager. And I guess bringing that to a close, we can take questions. I know it's a lot of information, but it is a bunch of themes that are converging, including one that I didn't emphasize that's making these catalogs available, and that's the fact that a lot of our heroes and rock stars of the past are getting older, and so it's turned into an estate planning era, at the same time that, the streaming is exploding around the world.
Great. All right. Thank you, Tim, for sharing that. Let's see here. I'm just taking the screen back. All right. Thank you for sharing that. Very interesting concept and different from what I think most people think about when we first hear self-directed IRAs, or what people might have heard about self-directed IRAs through word of mouth. It's usually real estate that people assume is just kind of the only option. So as you can see here, there are a lot of different ways you can get creative and think about doing different things that can benefit you. If you do have questions, if you don't mind just holding them or putting them into the box, we'll address them at the end of this, and we're happy to take any and all questions. What we're going to do for just the next few minutes here is just apply this to using the self-directed IRA as an investment tool or investment vehicle for investing in music royalties, as Tim described it. So basically, I'm just going to take you through a quick, for anyone who is new to the concept, I'm just going to go over the concept at a high level, and then we'll talk a little bit more specifically about if you wanted to do an investment like this with an IRA, how you would get started, what would be required, and what that process would look like. So our role in this is to act as a custodian. We're not financial advisors, but we are responsible for holding the self-directed IRAs for investors and doing all of the record keeping and the administration, tax reporting for those accounts. So while we don't provide investment advice, we're a neutral third party, and having a custodian is required in order to establish a self-directed IRA that would enable you to do these types of private investments. As I had just mentioned, as a disclaimer, we don't provide investment advice. So what makes this a little bit different is we're not like a Fidelity or a Schwab with self-directed investments and self-directed IRAs. The account holder actually does their due diligence, which is why we often co-present this education with different organizations to provide different ideas and education on these different options for you, the investor, to decide what you think is best for you. Just a quick background on the company. We've been in business for 16 years and are a women-owned business in northern New Jersey. We have been in the space for quite some time and have a focus, well, geographically, we have clients and investors everywhere, but we have been involved in a lot of the publications domestically and internationally related to wealth advisor, self-directed IRA custodians, Forbes Finance, and usually publish a lot of thought leadership through these channels, as well as provide education like we're offering today. So the self-directed IRA, and what makes it unique from just any IRA that you might have or have heard about, is the ability to invest in non-publicly traded alternative assets, right? So what Tim is talking about, music royalties, at least right now, is private. And if you had an IRA with Fidelity or Schwab, for example, they do not hold private investments in IRAs and retirement accounts. So if you wanted to get in ahead of an IPO, for example, and get that into your retirement account prior to, you would have to use a self-directed IRA in order to do that. Obviously, one of the benefits is the tax advantage of getting into a private investment with a retirement account, whereby your investment earnings and returns are going to be tax sheltered because they're being funneled through a retirement account. So depending on the type of account you have, they'll either be deferred earnings, where you'll pay taxes on that when you withdraw funds at retirement, or they'll be tax-free earnings if you have a Roth IRA. So just understanding the different account types is helpful. And obviously, aside from opening up the types of investments that you can do by being able to invest not only in public securities, but also in private assets like this, you're further diversifying your portfolio, which allows you to hedge against some of the stock market volatility that we've seen, and also to ideally you're going to generate more stable returns over time because alternatives tend to, to be less correlated with public assets as well. So just really quickly why this is important. As I think a lot of people know, some of the resources that historically Americans have been used to relying on for retirement are thinning or no longer available. So Social Security is really limited in terms of what future generations will be able to pull from when they retire. And some of the old pension and defined benefit type plans that had pretty generous benefits for retirees are not really being offered by employers anymore because they're either too expensive or they're just not feasible anymore. So what this means is that a lot more workers are delaying retirement because they don't have enough saved, and they're having to continue work. So one of the things that this is doing is putting onus on us as individuals to figure out ways to accelerate our retirement wealth and to build that wealth not only for our retirement, but also to leave a legacy that can be passed down to our offspring and our family and future generations as well. So the different types of accounts are here. As I had mentioned earlier, depending on what type of self-directed account you establish, there are different tax implications. So generally, they're going to either be tax-deferred earnings or tax-free earnings in a Roth. And then there are also account types designed for business owners, SEP simples and employer qualified plans that allow for greater contributions out of pocket to start depositing funds into those accounts and growing it over time. And then there are a couple other different account types that can be self-directed, not necessarily for retirement, but as you can see, the education savings accounts can be directed for tax-free withdrawals to pay for child's education. And the same goes for health savings accounts for any related medical expenses. So in order to get funds into a self-directed IRA, you can make a contribution just as you would be able to do with any other retirement account. The IRS sets those limits as to how much you can deposit on an annual basis, depending on your age and the account type. If you have an existing IRA with another institution, that can be transferred from that institution to the new self-directed IRA so that you can use all or a portion of that cash to make private investments through your retirement account. If you have an old 401k, if you've recently been laid off or you've separated service from an employer and you have an old account that's just sitting there, you can take those funds or a portion of them and roll them into a self-directed IRA. So there are a few different options to either take funds that you have existing or deposit new funds into an account. And then, as we mentioned, there's a plethora of investments out there. Today we're talking about music royalties, obviously, and we're looking at it from a private equity standpoint. So investing into a private company or private stock using the retirement account. But as you can see, there are lots of other things here that also can be done. I'm not going to get into those today, but you can also do further research, and we do have other education on those topics if they're of interest. But just about anything that's not public can be held in the self-directed IRA, with the exception of, as dictated by the IRS, the exception of life insurance and collectibles. So as long as what you're looking at doesn't fall into those two categories, it is game for consideration. So what we're talking about today as it relates to music royalties is using your self-directed IRA to invest in a private company or a fund, right? So in this case, what would happen is you would establish your IRA, you would fund it either by contribution, a transfer, or a rollover of cash. And then you would direct your custodian, which would be Next Generation, for example, to purchase shares of stock or purchase a portion of ownership in a company. And then we would collect information on that entity. And then we would, after doing a compliance review on those documents, send the funds from your self-directed IRA to that entity, in which case you would then have, your IRA would then have stock or equity in that. And in most cases, what would happen in terms of returns is you would receive a dividend. So I believe Tim had mentioned to me earlier that with music royalties, it's a monthly dividend, for example. So basically what would happen is that dividend would be deposited back into your self-directed IRA without you touching it. So by doing it in such a way, you're not triggering a taxable event, and your IRA is receiving passive income just as you would normally be doing if you were investing in other stocks or bonds, for example. Just a note that all of the returns must flow back into the IRA in order for those tax benefits and those tax advantages to hold. So Tim had also mentioned that there are considerations for companies going public after starting out private and then filing for IPO and going public. So oftentimes the question we get is, okay, you said I can use my self-directed IRA to invest in private assets. What if I do that and then it goes public? So what you would do in that case is you would, if you had your account with Next Generation, you would contact your custodian to let them know the asset that I've invested in is now public. And since we do not specialize in holding public assets, what would happen is the shares or that portion of ownership that you have will be transferred as it is from your self-directed IRA directly back to another IRA or retirement account that gives you the options to hold public stock. So again, there are tons of custodians out there like that, like Fidelity or Schwab, that would then take those. And by transferring them from one IRA to the other, again, you're not triggering a taxable event or any penalties. So you will have kept those tax advantages. And then at that point, the receiving custodian on the other end would confirm that they've received the shares from us. And then at that point, you can decide what you'd like to do. You can either continue to hold them or you can sell them and trade them using the brokerage account. So in order to make an investment in a private company with the self-directed IRA, once you've set up your account and you've funded it, there's some documentation that would need to be submitted to your custodian for review. There's internal documentation that we would require, and basically it's a direction of investment form that you would complete to tell us, I want you to take X thousand dollars from my IRA. I want you to send it to such and such a company. I'm going to buy this many shares at this price. And here's the routing information for the account where the money should be sent. If you want it wired or you want a check mailed. So all those decisions are yours as the self-directed investor. We take that direction from you, and then on behalf of your IRA, we process those transactions. And then supporting documentation on the company itself so that we can determine whether this asset you're looking at is feasible for us to hold in your IRA. And we're also looking to see that everything is labeled appropriately on those documents. So the investor should be listed as the name of your IRA and not your personal name in order to allow for those tax advantages. So those are the things that we would do a review on. And then once that compliance review is completed, we'd be able to move forward with processing those transactions. Something important to note, and it doesn't really come into play as much with these types of investments when you're investing in private equity or private companies, or that the IRS does have certain rules around what you can and cannot do when you're investing with an IRA. So there are different types of what they call prohibited transactions that are not permitted. So what they basically say is your IRA can't get into an investment transaction with any disqualified person. And they define those here. So if you had a self-directed IRA, for example, disqualified persons would be you personally, yourself, spouse, any ascendants, descendants, and their spouses. So if you look at your family tree up and down, parents, grandparents, children, grandchildren, those relationships are not persons that you can invest directly with using your IRA, as well as any companies that are majority owned by a combination of those people, or anybody that's providing a service to your account, so that they're avoiding any conflict of interest when it comes to your investments. So that's one of the other things that we look for when we're looking at those documents and doing that compliance review is that you're not getting yourself into a prohibited transaction, because the consequences would result in a distribution of your account, and obviously penalties and taxes would apply. So that's not something that we would want to happen, and that's why a custodian is important when we talk about going through this process the right way. A couple of examples of things like prohibited transactions that would apply to a private equity type investment would be if you're investing into a company, into a startup or a private company, for example, or a fund. It cannot be, as I had mentioned earlier, 50% or more owned by any of those disqualified people. If you're using your IRA to invest, you cannot personally be an active partner, director, or managing member. So it has to be passive. So you're not double benefiting in the sense that your IRA is getting a return and that you're personally getting some benefit in the short term. And then lastly, as I had mentioned, the earnings or dividends cannot go back to you directly from the IRA. They have to go, from the entity. They have to go back into your IRA. And then if you wanted to take funds out from that point, you would request a distribution from your IRA. And then, of course, that would be fine. And depending on your age and your circumstances, the taxes may or may not apply at that point. So the process for getting started with something like this is opening an account by filling out an application, which takes about 1 to 2 business days. Funding through one of the methods that we went over, so contribution, transfer, or rollover. And this can take as little as a few days or a few weeks, just because there are different processes that each institution goes through to release your funds on their end and send them over to your new account. So it'll depend on their processing times and what they require from you in order to confirm and get your authorization to do that. And then making the investment, we had discussed the documents that would be required to do that, and that compliance review that's done on our end, and that would take about 2 to 5 business days for that review to be conducted and completed. So all in all, we like to say conservative estimate is usually about 4 to 6 weeks from the time you get started with an application, get the account funded, get the documents in for review, and get the transaction processed. So it's definitely a different way of thinking about investing, because obviously if you're doing it with personal funds, you'd probably be able to turn it around a lot quicker. But where an IRA is involved, there are different and more steps to the process, of course, because we do have to take into consideration some of the IRS rules, proper documentation, proper coding for tax purposes. So we need to make sure that we follow every step thoroughly and accurately. But of course, then the benefit to doing this way, although it may take a bit more time, is the tax advantage. So with that, that was pretty much a high level on how things would work with an IRA investing in music royalties and this type of investment structure, whether you think that it would be beneficial to do it with your own personal funds, or you'd like to consider doing it with an IRA. You will have our contact information and information for Tim and Connor as well. You can feel free to browse the website for more information. And as I had mentioned earlier, this recording will be provided to everyone, whether you are able to attend today or not. So I want to thank everyone for their time. And I think we do have some questions that I'm going to read back. So the first one I have is, and I believe this is a question for you, Tim. What is the structure in terms of, okay, it's worded a little strangely, but I'm going to read it as it's worded, and then we'll see if we can translate this. So what is the structure in terms of promoting to you as managers, etc.?
Well, we're 50 million shares outstanding in total at this point, and as the founding investor, we have 10 million shares, and from the point of view of the incentive is to increase the dividends. So that's aligned with the shareholders, and we kind of think of our shareholders as partners, because we believe if we keep growing this and getting people involved in the music business or fans, and they look out for the only 2 things we're doing are raising more capital and buying more catalogs. So in that way, investors can even think of themselves as contributing to the growth of the entity.
Okay, that makes sense.
And maybe I'll just elaborate by saying the whole point of this structure is to take those passive income streams or cash flows into the company and then to pay them out with the least amount of cost, right? So we're more akin to the ETF, with minimal costs. We obviously have costs of, accounting and legal to get transactions completed or due diligence, some marketing, there'll be listing costs, but, at the end of the day, at the incremental level, if we can bring in incremental millions of dollars, then, that will, more than offset the sort of $200,000 or $300,000 we think of running the company.
Okay, thank you, Tim. And this is another question for you as well. Can you explain why the Taylor Swift situation isn't a problem for music royalties? What stops other artists from re-recording their masters? And what is the impact of this on an investment vehicle like yours?
Well, the thing about it is, I know I'm speaking as an outsider to the music business, but when it comes down to it, obviously it's always personal when you're talking about an artist and their creations and so on. But if I can use the Dancing in the Moonlight argument, if you go beyond, you're the only one that can perform it and you can get it covered by other people or in other languages, other genres even, then think about it as a creation, if you will, that has multiple purposes. So if you haven't translated your language into and modernized it into modern versions all over the planet, then you haven't actually exhausted the potential, the infinite potential, as we would call it, of that particular creation. So when you talk about our interests come from, a 1/8 recording going back 50 years, which is growing because it's being rediscovered, but it's also being rediscovered by other versions. So our version is from the King of Harvest, the original band. It was redone by Top Loader, I think, around 2008, by Jubel in 2020, and so on. So those creations are increasing the revenue and the interest for us. So it's a benefit for all involved. If you're thinking about it as maybe perhaps the way an artist would, as controlling their creations, then obviously they have a different perspective. So, I think I read that the Beatles' Yesterday song has been covered by 2,000 other bands over time. So it shows you how broad and wide, an individual song can be used, right?
All right. Okay. Thank you for that. Are there any other questions before we wrap up here? Questions about music royalties, questions about using IRAs?
Well, I might, to the extent that you got another question, or I just might, comment and recap in the form of saying, we're excited about this asset class because we know nobody has an interest in the income of their favorite music bands or artists. So to the extent that we create a portfolio that's diversified and is, ideally the best music that's ever been created, then we know there'll be an interest that potentially could be, a viral fan increase. So regardless of the fundamental acquisitions we're doing, it's a fun asset class. It's a new asset class. It's complements of the internet infrastructure and the growth in streaming. So it's the one sliver of something that you know and love but don't own, and that's really what we're trying to do. Just it's obviously it's a financial product. We're not in the music business. We're just aggregating a diversified portfolio, so it's not taking on the risk of a specific artist, like you have a piece of just Taylor Swift or just the Beatles or just the Rolling Stones or that kind of a thing. The whole point is to put your investor pension retirement hat on and participate in this growth story from an income point of view.
Right. Yeah. And passive investments in general, like that, are are primed for self-directed IRAs because you think about the types of returns people are getting in the market, in the public market, and what that could potentially look like with other other options. And obviously the fact that they don't require active management on the investor's part, but still bring in those tax advantages. So it makes a lot of sense. So I don't think we have any other questions. Tim, do you have any other final comments before we wrap up?
No, just I would only emphasize, to the extent that you have Spotify and iTunes, you can download the playlist of our top songs. It's the top 60 or 70 songs, and you get a feel for the breadth and the iconic nature of some of the songs we have an interest in. And that, of course, is where the revenue is being generated, which is, of course, what in turn is paying your dividends, which is, a fun thing to say, that you have a piece of can't get no satisfaction all the way to don't stop the music, and you're, in quotes, an owner. And finally, of course, when we think we can get that U.S. public symbol, we think millions of potential fans, of the hundreds of millions of listeners on just even Spotify of this music, will create an incredible demand for the stock as a public company.
Great. Well, thank you, Tim and Connor, for your insight and your knowledge on this topic. And I'm sure that our audience appreciates it. It's definitely something that I also didn't know a lot about. So thanks again. We will be sending out this recording, and if anybody would like to get in touch or have a one-on-one discussion, or if you think of any other questions that come up after the session, please feel free to reach out to any of us. Hope everybody has a safe rest of the week, and happy holidays to all. Have a wonderful day.
Thank you.
Thanks.
Bye for now.